Hi, I'm Stephen Foerster, and this is the Earn and Invest podcast.
Stories. Stories tell the truth in a way that bland information just can't. I remember hearing about the difficulty of medical school and residency while in college. While I logically understood the information, it really didn't have much of an impact. And then I read House of God, a fictional but all too real accounting of medical residency by psychiatrist Samuel Shem. And I actually started preparing myself for the grueling onslaught that was about to befall me. That story helped. Many people come to money and investing with a similar lack of knowledge. We have been told to invest with our minds and not our hearts. We have been warned of FOMO and blindly following the crowd, but many of us don't listen. My guest today aims, my guest today aims to alleviate this problem by telling better stories. Stephen R. Foerster is an award-winning author and professor of finance at the Ivey Business School at Western University in London, Ontario, Canada. His latest book, Trailblazers, Heroes, and Crooks, Stories to Make You a Smarter Investor, is an insightful look into key stories from history spanning from before the Middle Ages to the modern day. Stephen Foerster, welcome to Earn and Invest. We hear this all the time. Past performance is not indicative of future returns. Every time we go to invest, someone warns us of this. How do we then use the past to become better investors today?
Well, that's a great starting point. I would argue that past stories can help us in the future, not past performance, but past stories. We can learn from those stories, and we can learn from others' mistakes, and hopefully avoid those mistakes.
Yeah, the old saying, right? The past doesn't repeat itself, but it sure does rhyme, comes to mind as you say that.
Absolutely.
We're going to talk about some of these historic disasters and even some historic heroism in a moment. But let's hear about your own personal journey. Any early investing disasters you want to tell us about with your own portfolio?
Sure. What I sure what Sure, I can share one of my disasters, if you will. And this was based on looking at research that I and others had done, particularly related to initial public offerings. There's a lot of evidence out there that on the first day of an initial public offering, the price tends to pop. On average, in the US, it's about 15%. But most of us aren't able to get in at that particular price. And so it's really looking at what happens to that recent IPO subsequent to that first day. And there's a lot of evidence that IPOs tend to underperform in the next 3 to 5 years. So armed with that knowledge, this is going back quite a while now, I noticed that there was one really hot tech stock that was performing exceptionally well. And not with a lot of hard evidence. I just had this feeling, given what I felt I knew about IPO performance, that this stock just couldn't sustain itself. And not only that, I somehow convinced my son, who was into developing some websites at the time, even though he was just a teenager. I got him convinced as well that this particular stock was overvalued. So I decided to make a bet against this stock. I didn't know when it was going to happen, but I was pretty confident it would happen in the next 2 years. So I bought long dated puts, basically betting that the stock price was going to go down fairly dramatically from where it was. That stock was Google. And I was absolutely wrong. Had I bought calls versus puts on that stock, I would have been quite rich. But that informed me in terms of my stock picking abilities, or the lack thereof.
And history tells us that picking stocks is difficult. And I really see this thread throughout the stories you tell. As you talk about these different big topics, it becomes clear that it is really, really hard to stock pick. Let's talk about some of these stories and some of these big lessons. The first one, which is the very first story, really to me talks a lot about cause and effect. And this involves historic soccer player Cristiano Ronaldo. Basically, there was a snub of Coca-Cola, right? He had a press conference. He replaced the Coca-Cola bottles with some water bottles that said not Coke on them. And I think that day or the very next day, Coca-Cola dropped in the stock market. The company lost 4 billion in a matter of days. Tell us what happened there, and was it due to Cristiano Ronaldo?
Sure. So let's start with the story itself. And as you've described it, this was in 2021 in the Euro Cup press conference, Coca-Cola being a big sponsor. And as was standard, there were two Coke bottles prominently displayed, which Ronaldo immediately removed and grabbed a bottle of water and encouraged people not to drink Coca-Cola, drink water. On that day, Coca-Cola's stock value dropped by $4 billion. So that's what happened on the day. That became a story because Ronaldo off the field, one of the greatest influencers. And if we measure that, for example, by Instagram followers, he's actually number one and continues to this day to be number one in terms of the hundreds of millions of followers that he has. So clearly we put the two things together. Ronaldo is an influencer just by the number of followers on Instagram. And the other observation is Coca-Cola's stock value dropped by $4 billion on the day that this press conference took place. Washington Post and many other reputable mainstream media organizations wrote up this story, making this connection. Look at the influence that Ronaldo had. That's not the story, though. If we go behind it, and this is where we really have to dissect what was happening on that date. Little backtrack, and an important piece to this particular story is what else was going on with Coca-Cola just by coincidence on that particular day. This was a Monday afternoon in Europe, Monday morning in the U.S. In New York when the stock market was just opening. Coca-Cola and many other companies regularly pay dividends, typically four times a year. And there's a regular announcement roughly 2 weeks before the dividend is actually paid. The company says, okay, on such and such a date, we're going to be paying the dividend. And approximately 10 days, 2 weeks before that date, if you own the stock on that day or prior, you will be getting this upcoming dividend. If you own it the next day, you won't be getting the dividend. This is all known in advance, no big surprise. And so let me just take a hypothetical example, Jordan. Let's say it's a stock that is selling for $20 a share, and the upcoming dividend is expected to be $1. What we expect to see happen is that if you own the stock price but before the stock goes what we call ex-dividend, you get that upcoming $1. If you don't, the next day, you don't get it. So the stock price is priced in. It's selling for $20 in this example, anticipating that you're going to be getting that $1 dividend. Once it goes ex-dividend, we would expect to see the stock drop by approximately $1 because that new investor no longer has an ownership stake in that upcoming dividend. Well, guess what was happening on the day of Ronaldo's press conference? This happened to be the day that Coca-Cola was going ex-dividend. And so this was a Monday morning in New York. So what one would expect right at the opening is that you would expect the stock price to go down by the approximate amount of the dividend. Now we're talking Coca-Cola, which is a multi-billion dollar company in terms of its value. $4 billion sounds like a lot of money, but it was more or less reflecting what this dividend was going to be. And in fact, the drop that Coca-Cola experienced that day all happened before the press conference. Coincidentally, it was minutes before the press conference. So what happened actually after the press conference is that Coca-Cola stock actually marginally increased during the rest of the day. And so this is a classic case. So that the punchline of this story is we really have to be careful in terms of correlation versus causation. Was there a correlation on Ronaldo moving the Coke bottles and the stock going down? Yes, absolutely. It happened both on the same day. Was it causation? Absolutely not. So that's one of the themes. And so I get into talking about what does cause stock prices to move. And so that's a story in and of itself that we should be aware of. But Ronaldo did not cause Coca-Cola stock to go down by $4 billion that day.
Yeah, I mean, it reminds me of two things. One is people don't understand dividends. Clearly, I've noticed this over and over again. People think magically they get a dividend, but the value of the company doesn't change on the day that the dividends are given out. And they don't realize that there should be a drop in the stock price along with the dividend, and that it does tend to climb over time because these are growing companies. But it amazes me that people still don't understand that concept. That's one. The other is this connection between causation and correlation. Correlation is rife. We can find correlation in almost anything, but causation is a much higher bar. And I think we see this over and over again with mistakes, whether it is in medicine, whether it's mistakes in personal choices we make, but we certainly see this in the stock market, that we decide we know what is a causative factor, and it ends up being a correlation at the given time, but not for long term. So this is a place where people make a lot of mistakes. Correlation does not equal causation.
Couldn't say it better, and we just have to keep repeating that to ourselves.
Something that really hit me during this book is something you call masterly inactivity. And again, being a doctor, a famous saying was, don't just do something, stand there. This idea that we as doctors always wanted to do something when we probably should be using this masterly inactivity. You tell a story about Muhammad Ali and actually intertwine it with Jack Bogle. So what do they have in common, and how does that relate to index investing of all things?
Sure, and I can relate this even back further to thousands of years to a Roman dictator, Quintus Fabius. This is something that relates coincidentally back to soccer, but also medicine, and I'll talk about that as well. And so this term became known as masterly activity, which goes back to this Roman dictator, Quintus Fabius. So let me start there. He had a really huge task as he was appointed dictator. He had to try to defeat the famous Carthaginian Hannibal Barca, who was ravaging famously with his army of elephants through the Alps into Italy, and had victory after victory after victory. And so as a Roman dictator, Fabius had to try to put an end to it. He brought his army and set up camp not far from where Hannibal was. Hannibal knew that this was happening, and so tried to draw Fabius and his army into a battle. But nothing happened. Fabius didn't take the bait and just stood firm. And the reason he did that is because he wanted to wait. The timing he felt wasn't right. He wanted to reinforce his army, get more supplies. And so he created what became known as this masterly inactivity. As you note, the really the art of doing nothing. And it wasn't until he was able to strengthen the army that Fabius did then finally decide to act and had this major defeat. So fast forward to Muhammad Ali. This is 1974 in Zaire, Africa. His famous fight against George Foreman. Many of your listeners might know George Foreman for his post-boxing days, for his grill, that he made more money out of the grill than in his boxing career, but was at the time world champion. Muhammad Ali was way past his prime. He had been the former world champion. He got stripped of his title because he refused to serve in the army, and so he was trying to make a comeback. He was in his 30s. In this particular fight, some odds makers gave Ali 40-1 odds. Foreman was bigger. He had a bigger reach. He was stronger. He had a better record at the time. So this became known as the Rumble in the Jungle. And here's what Muhammad Ali became famous for at this particular point in his career. He had been, the expression that had been used is he used to float like a butterfly. He was very light on his feet and he would dance around. But in this particular fight, he just tried to protect himself up against the ropes, and this became known as the rope-a-dope strategy. He let Foreman do his thing and punch and as he could, but Ali protected himself. He let the ropes absorb a lot of the punishment, and basically he did nothing. It was masterly inactivity. And eventually, after about 7 rounds, Foreman had exhausted himself, and that's when Ali sprung to action and knocked him out and had this huge upset win. So again, masterly inactivity saved the day. And then the third person that you mentioned, Jack Bogle. Jack Bogle started the Vanguard group in the mid-1970s. And he became famous for creating the first mutual fund index fund. An index fund simply tries to replicate a market like the S&P 500. The notion here is that if you can't beat the market, let's join the market. And what Bogle created was a very low-cost, effective way for investors to get diversification. And he really popularized a really boring strategy: buy and hold an index fund. And this is really classic masterly inactivity. And this is really the saying that you mentioned, what was also one of Jack Bogle's famous sayings. If your broker calls up and said, oh, the market's crashing, you've got to do something, just tell your broker, don't just do something, stand there. And masterly inactivity, just to sort of close the loop here, has applications in medicine as well. As you know, sometimes you have patients who come to you and want something done. I need something. I need some drugs. I need a procedure. Whereas what does the body really need? It just needs time. It needs you to do nothing. Clearly, you're going to want to watch your patient and monitor your patient. But again, masterly activity often wins the day.
What do the studies show about people who trade often? The exact opposite, hyperactivity. What does that do to a portfolio?
Studies have shown that on average leads to underperformance. And there's also a gender difference. It's males that tend to trade more excessively than females, and consequently underperform even more. So again, studies suggest that on average, doing nothing, and by doing nothing in this context would be buying and holding a boring index fund. Are you going to be popular at a cocktail party? Absolutely not. But you might be better off financially over the long term.
So we've been talking about these big investing principles and what historical stories can tell us about them. We started by talking about cause and effect, and that was the Cristiano Ronaldo story in Coca-Cola. We moved on to masterly inactivity, Quintus Fabius, Muhammad Ali, Jack Bogle connected them all with masterly inactivity. I want to move to a concept that a lot of people in investing have trouble with, which is opportunity cost. And that brings us to Bobby Bonilla. I think there's such thing as Bobby Bonilla Day, right? So Bobby Bonilla
Yes.
somehow ended up with a deal in which he gets paid over $1 million every year till 2035, even though he retired a long time ago. What a lot of people don't know is that he gave up his salary for a year in order to be paid later. Was that a good deal, first and foremost? And what does this tell us about opportunity cost?
Sure. So was it a good deal? Yes. Was it a really good deal? Yes. What was it an exceptional deal? No, it was a pretty fair deal. So let me try to give some context here. A little bit of background in terms of Bobby Bonilla. He played for the Mets. He was a very promising star. He got a really good contract. Then he disappointed. He was traded. He ended up winning a World Series for I believe it was the Mariners. I think it was. Um, Mets decided to trade for him again, and again we're disappointed. So this was right around 1999. His agent Dennis Gilbert had negotiated one of the top salaries for Bobby Bonilla, and at the time, Bobby Bonilla was expected to get a salary of $5.9 million in the year 2000. And so this is where, through his agent and with the owner of the Mets, they negotiated this buyout. Bobby Bonilla would give up the 5.9 million in salary in return for what became known as a deferred annuity salary, where he would not start getting some compensation, but eventually he'd be getting $1.19 million a year for a 25-year period, starting in I think it was around the year, I think it was 2010. I can't remember the particular year. And so each year, July 1st, Bobby Bonilla gets $1.19 million, which even today is more than the salary of some of the Mets players. And so this is where poor Mets fans complain that, oh gosh, here's Bobby Bonilla getting more than some of these players, and so they made a day out of it. So let's just parse this in terms of was this a fair deal or not? And so what we have going on here is, as you mentioned, this notion of an opportunity cost. And so what we have here is Bobby Bonilla agreed to give up something for allowing the Mets then to spend more money on other players, which they did, and actually came close, didn't quite make it to all the way to the finals and to win the World Series, but they were able to make some good trades, pay some of their players some good salaries, and so what was built into the contract is that Bobby Bonilla was given the equivalent of an 8% return on this $5.9 million that he gave up. This was a time when risk-free government bonds were yielding about 4.5%. You could have earned more than that in the stock market. You probably over the long term would have been able to earn, let's say, 10% or perhaps a little bit more than 10%, but obviously with a lot more risk. So you put the 8% in between the two, and that's a fair compensation, probably even better than fair compensation because it was basically risk-free. And why that's important is because really this whole notion of opportunity cost is something that gets built into how we price bonds, how we price stocks. Really, we can think of any security as in terms of what we call time value of money. A dollar today is worth more than a dollar tomorrow. Bobby Bonilla was giving up $5.9 million in return for an expectation that he would get these cash flows going forward. And so that's a fair trade-off. If I own a bond, I pay out, let's say, $1,000 for that bond with the expectation I'm going to be getting coupons in the future, and I'm going to be getting my principal back. If I own stocks, then I expect to get, for example, dividend payments in the future, and I expect to get some additional money when I sell these stocks in the future. And so it works out that this was a fair compensation, and so really understanding opportunity costs is really critical.
Yeah, if this idea of having a Bobby Bonilla day for yourself is really exciting, you could always look into annuities. I mean, there's the added risk-benefit ratio of how long you live and how that plays into the risk. But this idea that you get a certain percentage off of the money every year, you could create your own Bobby Bonilla day for
Yes.
yourself.
Yes, absolutely. Absolutely. There's another angle to this, and it actually ties into a different story. So the owner at the time, Fred Wilpole, was happy to provide Bonilla and his agent with this guarantee of 8%. And it turns out that he was doing very well with his own personal investments. And he had this particular hedge fund that was providing him with over 10% a year with virtually no risk whatsoever. So he was getting this great return, or so he thought. And that particular investment happened to be with the infamous Bernie Madoff. And so that's a whole other story that I tell, which was the biggest Ponzi scheme ever.
We are talking to Stephen Foerster. He's an award-winning author and professor of finance at the Ivey Business School at Western University in London, Ontario, Canada. And we are discussing what these historical stories can teach us and tell us about investing. We're going to take a short break. I'm Doc G, and this is the Earn and Invest podcast. All right, I'm going to jump back in a second. Any problems, questions?
No.
Awesome. Yeah, this is exactly how I foresaw it going because the storytelling is so rich. I almost want to get out of your way and let you just keep on telling the stories. All right. On 3, 2, 1. We are back with Stephen R. Foerster. His book is Trailblazers, Heroes, and Crooks, Stories to Make You a Smarter Investor. It is an insightful look into key stories from history spanning from before the Middle Ages to the modern day. And with Stephen here, we've been recalling and talking about some of these historical stories and what they have to teach us. I want to move next to one of my favorite stories because it has to do with FOMO, fear of missing out. We all know Isaac Newton. He was a brilliant scientist. He changed the world, but he was not necessarily a brilliant investor. He died rich, but one could argue that he could have died richer. What happened with Isaac Newton?
Sure. So as you say, we know him, the famous story that was alleged to happen as he's sitting under an apple tree and an apple comes down and hits him on the head, and that inspires him to think about this whole notion of gravity. Apparently, the tree is real and apparently still exists, but there's no documented evidence that he was hit by an apple, but certainly inspired by it. He had a great career post being a scientist, and really being involved in terms of in terms of helping to manage the whole treasury. And he had a lot of experience in terms of his own personal investments. And so this story talks about later in his career, not only for himself personally, but acting acting as an agent for an estate, made some investments in what would have been at the time, this is in the 1720s, one of the hottest stock investments. And this was something that was known as the South Sea stock. And in terms of what was happening with this South Sea stock, the South Sea Company was what was called a joint stock company, the precursor to what we would think of as publicly traded companies. It was incorporated as an act of the British Parliament, and part of what the South Sea stock was aiming to do was to make some money through trade in South and Central America. That was part of it. But the other thing that it was trying to do was to take off some of the burden of the public debt that Britain was facing. And so what was happening in 1720 is this South Sea stock was going from a price of around £10 a share up to £100 a share. And eventually throughout the end of the year, it plummeted back down to roughly where it started for the year. And there were all kinds of reasons for what was happening. It would be the equivalent in terms of almost some market manipulation and a lot of hype that was going on. But what's relevant for the story is that Sir Isaac Newton got in at a very low price, watched the price of South Sea stock rise, and sold out. He made a great profit, the equivalent today of millions and millions of dollars. Then what happened subsequently is the stock price continued to rise. And this is where FOMO comes in, fear of missing out. So not only for his personal account, but also for this estate, Newton decided to pile back into the South Sea stock almost at the worst possible time and ended up losing a bundle. So this is, I think, a key message for investors today and throughout history. We've seen a lot of hype, for example, in the last number of years with crypto. We've seen it with so-called meme stocks, and we get this hype and these bubbles, and often investors rush in at the worst possible time.
I want to talk about one last story in the book, and it focuses on how not to lose, right? So instead of thinking about how we should be winning, some of the most brilliant minds out there have said, let's concentrate on how not to lose. One of those is famed investor Charlie Ellis, who learned about index investing. And one of the ways he did was through reading a book about tennis. How did this somewhat unknown book change his and maybe all of our trajectories?
Yeah. Great question, and it's a great story as well. The person who wrote the book, quite a character in and of himself, Cy Ramo, known for a lot of technology related to intercontinental ballistic missiles, and he had a company made hundreds of millions of dollars on that. Very eclectic individual. Did a lot of writing, wrote some famous textbooks that sold millions of copies, but also just sort of on a whim, wrote a book called Extraordinary Tennis for Ordinary Players. And the premise of the book is that there are really two very different games of tennis played by you and me, versus played by professionals. The professionals play this game of tennis that you and I could never get to that certain level. They make these brilliant shots. They have these volleys that go back and forth for minutes at a time, and it's a beautiful game to watch. And they're really masters at it. And they win points by making this precise shot that just narrowly hits inside the court, and they win points. That's not the game that most individuals play in tennis. First of all, we often serve into the net. You might start to run in to the front, and you get caught halfway and the ball goes behind you. You hit the ball out a lot. And so the whole point is that amateurs end up losing points. That's how you lose the game. And so the whole point of Ramo's book was that if you want to win at amateur tennis, don't lose. That's the key. Don't try to be brilliant. Don't try to think that you're better than you are. Don't play like the professionals. Just simply try to not lose points. So fast forward then to Charlie Ellis. He's known as one of the wisest men on Wall Street. He started up a very successful consulting firm, and he was really struck by this book, not only as a tennis player but also as an investor. And that's where he made the connection. The lights, the light bulb went on, and Ellis thought that this whole tennis analogy was perfect for investing, because that's what he was observing in terms of professional investors. Yes, there were professional investors who seemed to do very well. There weren't many of them, but they really could do well. It was the amateur investors who tried to replicate and thought they were as good as the professionals who ended up losing. And so Charlie Ellis had a radical idea and was one of the first to really come out publicly to say that as an investor, you should try to not lose. What does that mean? That means you shouldn't be trying to pick individual stocks that you think are going to perform well. So what's the logical extension of that? And this was before we had index funds, but it was really a call to action that really we need something like an index fund. Investors should just try to replicate the market, don't try to beat it. And in fact, back to our friend Jack Bogle, this was Charlie Ellis's writing about his experience. He called it winning the loser's game. That was part of the inspiration for Jack Bogle to come up with these mutual fund index funds. The concept had been there, but nobody had created this mutual fund. So that's where tennis helped really to promote this so-called index revolution that we've seen over the decades, where now we're talking trillions and trillions of dollars of investors have their money in these passive index funds.
So, Stephen Foerster, I wanted to thank you for coming on the show today. Usually this is the point where I summate everything we've talked about, but instead I'm going to allow you to do that by asking a question. I began this podcast by asking, is past performance indicative of future returns? And that's kind of how we jumped into this. And really, your book has made the point that there are these trends that we can learn from history that will make us better investors. Cristiano Ronaldo taught us a little bit about cause and effect and correlation and causation. And basically, just because two things correlate doesn't mean that they're causative. We need to remember that. Muhammad Ali told us about masterly inactivity. It's not churning through lots and lots of trades. It's waiting it out and letting time do its proper course. Bobby Bonilla reminded us about opportunity cost, Isaac Newton and the worries about FOMO, and last but not least, Charlie Ellis teaches us how not to lose and to stop worrying about winning. will these concepts hold up? Every year, every time a market changes, every time we have something change like a pandemic, everyone says now is different. The future is unknown. These historical stories, will they still provide us the right direction in the future?
Well, I think what we have to do is we have to learn from these stories. And this book is not a here's what you have to do as an investor, but it's a really a call to action. You as an investor need to develop an investment philosophy. You need to come up with investment beliefs. I have my own investment beliefs, and a lot of these investment beliefs are based on my mistakes, and hopefully readers will see the mistakes that others have made to come up with investment beliefs. For example, an investment belief might be related to whether or not you think you can outperform the market in terms of your investment strategies. I'll share my investment belief is that's really hard to do. And so I'll share my primary investment strategy is to buy and hold an index fund. I'm not telling you that's what you need to do, but I believe we can learn from history and we can be better investors if we listen to the messages that history can teach us.
The book is Trailblazers, Heroes, and Crooks: Stories to Make You a Smarter Investor, in which you tell a bunch of these stories. Stephen Foerster, how can we get this book? And more specifically, if we want to reach out and ask you questions, what's the easiest way for us to do that?
Yes, easiest way would be through my website, stephenrfoerster.com. The book is available through Amazon and wherever you get your books. It's also going to be available as an audiobook if you prefer to listen to books.
Stephen R. Foerster, thank you so much for being on Earn and Invest today.
My pleasure.
That's a wrap. All right, I leave things running just for a few minutes to catch whatever bit of after show we have. Obviously, there's no way I could cover every story in the book, nor every concept. Anything we didn't talk about that you want to make sure people hear?
No, I mean, I think you really did a great job just sort of letting me babble away. And I think we covered a wide range of the stories. Obviously, don't want to give away all the stories. So you did a great job just balancing and covering a lot of territory.
Yeah, and we did not cover all the stories by any means. The problem with a lot of financial writing, honestly, is it's dry, right? This is always the problem, is we read financial writing and we get lost, or it's too quantitative, or etc. What I really liked about this book is it engaged me quite a bit, right? As I was saying to you before the podcast, I read it fairly quickly because I didn't want to put it down. But I feel like we learn better with these stories. And I really did want to bring it back to my dealing with, becoming a doctor. No one could teach me or tell me what being a doctor was like. No one could really prepare me. And yet it was something I really needed some preparation for, this medical school and residency and what it would feel like. And I remember reading this book, The House of God, and it was just such wonderful storytelling, right? And it was through those stories that I was able to get past kind of the emotional milieu that we put up in front of hearing information, get past some of that cause and effect and that kind of maybe more primitive thinking, and was really able to understand and digest the information. And while I was reading your book, I was thinking very much the same way, is to really digest some of these principles, because your average person's going to be like, yeah, I want to go play the stock market, right? They're going to want to put some money in. They're going to want to watch Apple real closely, or Google, or whatever they think is going to be the next Apple or Google, and try to time it perfectly to make lots of money. And you and I, who've been through a lot of this, both know that that's exceedingly difficult. Like you said, there's the top 1 or 2% who do this for a living, spend all their time, have, millions of dollars behind them in research, who can do that. But the rest of us most likely can't. I think stories like the ones you tell break through that barrier that just plain old didactic, straightforward teaching doesn't. And so that was one of the things I really kind of appreciated about the book.
Well, I really appreciate the comments, Jordan, because that's precisely what I was hoping for. And look, I'm not here to lecture, but I want to tell some stories, and I hope you get something out of these stories.
Was any of the stories particularly your favorite? Was there one that, or one that really said, "Oh boy, I got to make a book about this because this story is just such a great, anchor."
Well, I think the two, the Ronaldo one that we didn't get into, and that's okay, was the one about Warren Buffett and the salad oil
Yeah.
scandal. People know a lot about Warren Buffett, less so about that particular story. So I think that one is one of my favorites. I'm just sort of like a proud parent. I like all the children, but maybe not equally. But
Well, good. We'll leave people hanging on the Warren Buffett stories. So but there's lots of Bernie Madoff in there. There's Warren Buffett. There's all sorts of other stories, which I think people can sink their teeth into.
Perfect. Well, it's been a pleasure chatting.